We're starting off with a story that's been making waves in the airline industry. Southwest Airlines has been gaining momentum after implementing changes to its business model, and Morgan Stanley is taking notice. The bank has upgraded its price target for Southwest Airlines stock to $60, citing increased demand for add-ons such as better seats and a shift in capacity to stronger markets. According to Morgan Stanley's research note, the share of passengers paying extra for these add-ons has jumped from under 20% to 60%, and the bank sees no sign that this number has topped out. Additionally, Southwest appears to be gaining corporate travel share instead of losing it, which is a positive sign for the airline. Southwest's financials are also looking healthier, with revenue increasing by nearly 13% in the first quarter of 2026 compared to the same period last year. Operating profit swung from a loss to a $330 million profit, and net income came in at $227 million. The airline has been aggressively buying back stock and paying down debt, which has reduced its cash cushion but reflects a company returning excess cash built up during the pandemic. Analysts are forecasting that Southwest Airlines will end 2030 with free cash flow of $2.91 billion, compared to an outflow of $831 million in 2025. If the stock is priced at 15 times forward free cash flow, it could almost double over the next 4 years if we account for dividend reinvestments. Of course, not all analysts are bullish on Southwest Airlines stock, and some have raised concerns about the airline's debt levels and competition in the industry. As always, it's essential to do your own research and consider multiple perspectives before making any investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of finance and risk management, and today we have a fascinating story that highlights the importance of making informed decisions when it comes to our savings. You might have heard about the recent surge in inflation, which has made it even more challenging for individuals to save and grow their wealth. In this context, choosing the right savings account or investment vehicle can make all the difference. Our story today delves into the world of high-yield savings accounts, CDs, and Treasury products, providing insights into the top rates available and how they compare. We're looking at a new 4-month CD that pays an impressive 5.000% APY, as well as high-yield savings accounts offering up to 4.26% APY without any notable strings attached. Brokerage and robo-advisor cash accounts are also in the mix, with returns in the mid-3% range. Meanwhile, U.S. Treasuries remain a low-risk option, with current top rates of 4.99%. It's essential to consider these options carefully, as they can help mitigate the effects of inflation and grow your savings over time. To put this into perspective, let's look at some numbers. A lump sum deposit of $10,000 could earn around $247 in interest over 6 months with a 5.00% APY. That's a significant return, especially when compared to traditional savings accounts that often offer much lower rates. Of course, it's crucial to weigh the pros and cons of each option, considering factors like liquidity, risk, and flexibility. As we navigate the complex world of finance, it's essential to stay informed and adapt to changing market conditions. By making smart choices about our savings and investments, we can better manage risk and achieve our long-term goals. Whether you're a seasoned investor or just starting out, understanding the options available and their potential benefits is key to success. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to delve into a fascinating story that caught my attention: the remarkable rise of Figure Technology Solutions, or FIGR for short. This fintech company has been making waves with its innovative approach to mortgage and home equity line of credit services, leveraging blockchain and artificial intelligence solutions. Now, I know some of our listeners might be thinking, blockchain in finance? That sounds like a recipe for disruption. And you're right, it is. FIGR's use of the provenance blockchain aims to cut out middlemen, streamlining the process and potentially reducing costs. Meanwhile, their AI models bring significant computing power to bear on credit analysis, which could lead to more accurate assessments and better decision-making. But what really caught my eye was the recent surge in FIGR's stock price, rising over 21% in just 4 business days. This was largely driven by a bullish analyst note from Needham's Kyle Peterson, who reiterated his buy recommendation and $55 per share price target. Now, I'm not one to jump on bandwagons, but it's clear that FIGR is doing something right. As we dig deeper, we see that the company's acquisition of Kiavi adds significant origination volume and strengthens its marketplace scale. The PEG ratio of 0.77 times and consensus earnings growth of approximately 48% CAGR are also promising indicators. However, it's essential to acknowledge the potential risks, including execution risks, housing cycle sensitivity, and regulatory developments. While FIGR's story is compelling, it's not without its challenges. It's essential to do your own research, consider multiple perspectives, and weigh the pros and cons before making any investment decisions. So, what can we take away from FIGR's remarkable rise? Firstly, innovation and disruption can lead to significant growth opportunities. Secondly, it's crucial to stay informed and adapt to changing market conditions. And finally, always remember that past performance is not a guarantee of future success. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.